Welcome to Stress-Free Investing Analysis Personal Notes. Today, we're doing an executive memo breakdown of a really fascinating company, CONTROLPR Ltd. We're going to decode exactly what makes this business India's niche monopoly and see if it deserves a spot on your watch list.
I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
Okay, let's dive into this. Here is our step-by-step roadmap. 1. Meet India's niche monopoly. 2. Razor and blades model. 3. Uncovering the true financials. 4. Red flags and risks. 5. Valuation and scenarios. 6. The final verdict. Let's jump right in.
Section 1. Meet India's niche monopoly, the last domestic player standing.
Think about literally every packaged good you buy. Medicines, FMCG products, food, even steel pipes or cables. They all need batch numbers, expiry dates, and MRPs printed directly on them, right? It's a strict regulatory requirement. Well, CONTROLPR has a massive installed base of over 21,000 printers doing exactly this across India. And because India's manufacturing sector is expanding so fast, that number is constantly growing.
So what makes them a true monopoly? Well, they're literally the only domestic manufacturer of this equipment in India. Their competitors are these massive global giants like Videojet and Domino. But because CONTROLPR manufactures locally in places like Guwahati and Nalagarh, they have a structurally lower cost advantage. They can comfortably underprice those multinationals without sacrificing their own margins. Add to that a highly trained army of over 300 local service engineers out there, plus strong Make in India tailwinds, you've got a seriously protected structural competitive moat.
Section 2. Razor and blades model, the anatomy of recurring revenue.
And this brilliantly illustrates how they actually make their money. It's the classic razor and blades model. They sell the printer, that's the razor, which makes up about 18% of the revenue. But the real magic is the blades, the special inks, fluids, ribbons, and maintenance services required to keep that printer running for its 5 to 10-year lifespan. Consumables make up a whopping 58% of revenue, with services and spares adding another 24%. This means the vast majority of their cash flow is highly predictable, recurring annuity revenue that just grows every single time they sell a new machine.
Section 3. Uncovering the true financials, the illusion of FY25 PAT.
Now, if you just glance at standard financial websites, you're going to see a reported FY25 profit after tax of 100 crores. It looks incredible on paper. But here's the catch. That number includes a massive one-off deferred tax asset reversal of around 47 crores. The true, normalized profit from actual business operations for FY25 is actually 57 crores. Taking headline numbers at face value is dangerous in investing. So for all our valuation work today, we're setting this normalized figure of 57 crores as our true baseline.
Let's zoom out and look at their 10-year track record. They've delivered a really steady 14% revenue compounded annual growth rate. Back in FY16, they hit a peak return on capital employed of 28%. Post-COVID, in FY22, their revenue surged by 25% as manufacturing rebounded. Recently, they've entered a heavy reinvestment cycle, deploying 25 crores for a new plant in Assam, which brings their trailing 12-month revenue to a very healthy 464 crores.
Now, what's really interesting about this slide is the forensic quantitative scoring. The business looks remarkably clean. A Piotrowski F-score of 7 out of 9, that shows strong fundamental health. An Altman Z double prime score of 18.2 means their bankruptcy risk is practically non-existent, and a Benish M score of -2.9 shows absolutely zero statistical signs of accounting manipulation. Plus, they carry a debt-to-equity ratio of practically zero. It's basically a financial fortress.
Section 4. Red flags and risks. Radical transparency.
Okay, but remember, no investment is perfect, right? In the spirit of radical transparency and keeping our investing stress-free, here are the primary overhangs you really need to monitor. First, there's been a massive institutional exodus. DIIs dropped their holdings from nearly 10% down to just 0.28% over the last few years. Why did the smart money leave? Most likely because CONTROLPR acquired an Italian packaging subsidiary called V-Shapes, which has been consistently losing money and dragging down the overall consolidated margins. Because of this, plus rising local employee costs, their overall operating profitability has compressed from a peak of 32% down to 19%. Finally, keep an eye on the slow emerging technological threat of laser coating substituting their traditional inkjet printers.
Section 5. Valuation and scenarios. Pricing the moat. So how do we correctly price all of this? By weighing the current market price against those normalized earnings and distinct risks. When we look at relative valuation, CONTROLPR is currently trading at an enterprise value to EBITDA multiple of around 11 times. Compare that to global peers like Zebra Technologies or Videojet, which consistently trade between 15 and 20 times. CONTROLPR is trading at a huge discount, offering a really compelling margin of safety for a company that literally holds a domestic monopoly in a growing economy.
Let's break down the risk-reward asymmetry into 3 realistic scenarios. In our bear case, where growth slows and that margin pain persists, we see a target of 480 rupees, which is a 29% downside. But look at the base case. If that Italian subsidiary, V-Shapes, simply stops losing money and breaks even like management guides, our target is 850 rupees, a solid 26% upside. And in a bull case, fueled by potential new government mandates for Pharma QR coding and the return of those institutional investors, we could easily see a target of 1,100 rupees. That's a massive 63% upside.
Section 6. The final verdict. The stress-free summary. So the crucial point is, the executive memo gives CONTROLPR a final verdict to accumulate. Keep in mind, this is not a get-rich-quick trade. It's a patient play requiring an 18 to 36-month time horizon to let the thesis fully play out. The strong buy zone is anything below 600 rupees. The core thesis is pretty simple. You're getting a high-quality, practically debt-free niche monopoly with predictable recurring revenues, currently trading well below its intrinsic value because of some temporary subsidiary drags. It leaves us with a really fascinating question. In a rapidly growing economy like India, how long can a highly profitable, debt-free monopoly hide in plain sight before the wider market wakes up? Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I'm not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next explainer. Thank you for watching and keep your investing stress-free investing.